Friends, if you've ever stared at that brokerage screen thinking, what am I even doing here? Believe me, I completely understand because I've been there too. Most people in this position give up and spend the rest of their lives waiting for their paycheck, watching prices rise, wondering, why can't I ever get ahead? Today, I want to show you the way to change your life, my friends. With a single decision and a single portfolio structure, I will walk you step by step through how to build a dividend income machine. This is not about gluing yourself to a screen and day trading. This is about a simple yet incredibly powerful system that works in the background while you sleep, spend time with your children, or focus on what matters. And this is not abstract theory. As you'll see by the end of this video, someone named Emma can grow an initial investment of just $25,000 to over $2.5 million over the years. In this process, she can earn thousands of dollars in dividend income every year without constantly monitoring the market or chasing hot stock tips. So if freedom matters to you, stay with me. But first, let's talk about an uncomfortable truth. Most people do one of two things with their money. They either stay in cash or put everything in one basket. Cash feels safe, the balance stays intact, sure. But inflation quietly erodes that cash, years go by and you don't even realize it. Market shopping gets more expensive, rent rises, and the same lifestyle starts costing twice as much. On the other side, there are fixed income groups who say, I'm earning bond interest, I'm safe. It looks calm on the surface, but long-term inflation and taxes slowly squeeze that income, eroding purchasing power. Then there are speculators at the opposite extreme. They put everything into 2 or 3 stocks they're excited about. Everything feels great until a single bad announcement, a single scandal, or one poorly timed decision arrives. In one night, a large portion of their wealth vanishes into thin air. Most people caught between these two extremes stumble. They fear stocks, worry about cash due to inflation, and drown in information overload. That is exactly why I designed the dividend income machine. This is not a magic portfolio, my friends. It is a process that eliminates nearly universal mistakes. When you start asking not which stock to pick, but how many stocks to hold, how much to allocate to each, and how to spread across sectors, the game changes entirely. When you tie these 3 questions to clear rules, you eliminate 90% of the noise. You stop jumping from video to video and start building something that truly makes a difference. Let's define it. Your dividend income machine is a portfolio of dividend-paying stocks built with simple rules designed to grow both your wealth and your income over the years. It has one mission: to turn your capital into an engine that pumps out a reliable and growing stream of cash while you live your life. And like every machine, this one is made of parts. Assemble the parts randomly and it breaks down. Design the structure in advance and you get something powerful, predictable, and surprisingly easy to maintain. The structure of this machine rests on 3 pillars: how many stocks you hold, how much you allocate to each position, and the maximum weight of any single one. If you neglect even one of these pillars, things may seem fine for a while, but sooner or later the worst market will expose that weak point. Our goal is not perfection, it is resilience. We want a structure that survives bad news, can withstand hard blows, and still keep sending you cash every year. Think of it like building a bridge. It's not designed hoping storms won't come. It's built solidly enough that storms become an expected part of the journey. Let's apply Emma's real numbers to these pillars and everything will become clear. Let's start with the first pillar. How many dividend stocks should you hold to make your dividend machine both strong and manageable? Ask this question to investors and you'll get different answers. Some swear by highly concentrated portfolios, while others carry so many positions they can't even name them all. The problem with investing in just a few stocks is this: your entire future rests on a small number of decisions. One big mistake and your long-term plan takes a deep wound. If you have 5 stocks and one permanently drops 80%, that's not just a bad day. It leaves a deep mark on your long-term journey. On the other hand, if you carry 80 or 90 stocks, you'll be diversified, but you'll also struggle to track all the news, data, and fundamentals. You don't want to be an investor who owns everything but understands nothing. Instead of chasing either extreme, we aim for a sweet spot where you get broad diversification benefits without drowning in complexity or tracking burden. Dozens of studies show one thing very clearly: the more different stocks you add, company-specific risk drops very fast with the first additions, but beyond a certain point, new stocks only marginally reduce risk while the monitoring burden keeps growing. The return on that extra effort starts to shrink. For individual investors seeking dividend income, the reasonable range is generally somewhere between 15 and 25 stocks, depending on their time and comfort level. Below that, One bad pick hurts a lot. Above that, you start turning your portfolio into a personal index fund without the simplicity of an ETF. For our dividend income machine, I like 15 to 20. Enough names to spread risk, but few enough not to lose control. Think about it. Tracking 15 stocks is challenging but achievable. Tracking 67 stocks alongside work, family, and the rest of life is nearly impossible. So the first pillar is simple. Aim for a basket of roughly 15 to 20 dividend-paying stocks, not 5 and not 50. This way you're not burning your future on 1 or 2 heroes. You're building a team where a few players can have bad seasons without ruining the whole plan. This brings us to the second pillar. How much money should you allocate to each position within these dividend stocks? Many investors pick their favorites. They stack more money in the safe or exciting stock and leave tiny amounts for the rest as diversification. When you zoom out, the problem becomes obvious. Without realizing it, 3 or 4 names dominate, and they turn into hidden single stock bets. Even professionals with the greatest resources frequently get it badly wrong when trying to pick the next big winner. For individual investors, this is much harder. So instead of trying to predict the future, we have a more humble but more powerful approach. Start by keeping weights roughly equal. Equal weight means if you invest the same amount of capital in each stock, there's no single giant company that can sink everything when one fails. Say you have $10,000 and are building a portfolio of 15 dividend stocks. You're looking at roughly $600 to $700 per position. If you're investing $25,000 across 17 positions, you're looking at roughly $1,400 to $1,500 per company as a starting point. The exact number doesn't need to be perfect. The principle matters more than precision. Every brick in your wall starts at a similar size, so no single brick becomes critical. This way, one company cutting its dividend or falling into a permanent decline hurt, but it doesn't destroy years of careful planning in a single move. Equal weighting also protects you from your own overconfidence. Your favorite stocks no longer automatically get more money just because they feel emotionally safe. From time to time, some stocks will grow faster, and that is normal. At that point, you can decide whether to rebalance or let the winners naturally grow a little larger. What matters is this: you're not starting with giant bets. You're distributing your initial capital with discipline and letting the market show you which businesses truly deserve more space. So the second pillar, instead of making giant emotional bets on a few names regardless of how exciting they seem, start with roughly equal-sized positions. Before diving into sectors, let me take a short breath. If this content is helpful to you, write clarity in the comments so I can keep putting together this type of content. If you haven't liked and subscribed yet, do it now. It genuinely helps the channel grow. Now we can dive into the third pillar, the one many people neglect until they feel the pain firsthand: sector exposure. You can own 20 stocks, and if they all face the same risks or move with the same economic forces, you are dangerously concentrated. Imagine if everything in your portfolio depends on interest rates or commodity prices or a specific corner of the economy staying hot. When that particular area takes a hit, your supposedly diversified portfolio acts like one giant concentrated bet. Different sectors respond differently to inflation, interest rates, technological change, regulation, and business performance. That is exactly why sector diversification matters so much. In the dividend income machine, we handle this with a simple rule. No single sector can exceed 25% weight. So if you have 16 or 17 stocks, you're not piling them all into the shiny theme trending that year. Maybe you love banks, maybe energy, maybe you're obsessed with tech. The rule is there to protect you from overdoing any of those personal preferences. At the same time, sector diversification doesn't mean forcing yourself into business models you don't understand or would feel uncomfortable owning. You don't have to buy a complex biotech company you can't explain. That kind of diversification is a pure illusion of safety. A practical rule is this: if you can't explain the changes in a company in simple words to a young person, it may not belong in your personal dividend income machine. A healthy structure includes a mix of real asset exposures like energy, utilities, financials, healthcare, industrials, technology, and maybe some real estate investment trusts. You don't need all of them, but you don't want a portfolio where 14 of your 17 positions are tied to the same 3 macroeconomic variables. While one sector struggles, another can grow. Sector diversification allows the strength of one area to cushion the weakness of another while dividends keep getting paid. The third pillar is therefore very clear: a 25% cap per sector, as long as you truly understand what you're buying. With these 3 pillars in place, we can finally build a real dividend income machine example for Emma. Let me introduce introduce Emma. She is not a professional investor, my friends. She is someone with an ordinary job and a family who has very little time to research markets. After years of saving and making small investment attempts, she finally builds up $25,000 that she wants to dedicate to a long-term dividend strategy. She doesn't want to day trade. She doesn't want to check prices daily. She wants a system that can accumulate wealth and income in the background. Together, we decided to build a dividend income machine for Emma with 17 stocks, all dividend paying, spread across several key sectors. Part of this group operates in energy and utilities. They provide essential services regardless of economic cycles and generally pay stable dividends. Others come from financial and insurance businesses. They manage risk, credit, and capital accumulation and reward investors with payments that grow over time. We also included healthcare stocks with strong track records because people don't stop needing medical care even when economic conditions get tough. In addition, there are a handful of large, profitable technology and industrial businesses that have matured enough to share profits but continue to grow earnings. Each of these 17 positions holds a roughly equal starting share of Emma's $25,000. Following our equal weight principle from the second pillar, Emma doesn't secretly turn any single stock into a giant bet. Every part of the machine starts with similar importance within the structure. When these groups come together, they offer a blended starting dividend yield, a history of dividend growth, and price appreciation potential across many positions. We are not assuming perfect futures. We are asking a simple question. If these metrics continue reasonably on average, how does Owen do? Let's walk through a hypothetical scenario. Emma makes a one-time investment of $25,000, reinvests all dividends, and lets the dividend income machine run for 30 years. In the first 10 years, the combination of price appreciation and reinvested dividends could push her portfolio above $100,000 without any additional contributions. After 20 years, the effect of compound interest becomes much more visible. Combined with annual dividend income, it could exceed $500,000. Under reasonable assumptions, in roughly 30 years, the initial $25,000 alone could exceed $2.5 million, while generating thousands of dollars in dividend income every year. At this point, my friends, the story is not about a big number in an account. It is about choice. It's about working because you want to, not because you have to survive. That is what a well-designed dividend income machine truly offers. Not magic, not guarantees, but a real chance to reclaim your time through discipline and structure. Like this video, subscribe, and tell me in the comments what your annual target dividend income is. And watch the next video on screen to learn how you can get started even with small amounts.